Welcome to the second part of our discussion of accounting in the business environment. In this discussion, we're going to go over the accounting equation, as well as looking at the components of it with the assets, liabilities, and equity. We'll then apply some various transactions to the accounting equation, and then wrap up looking at the financial statements. So within our first objective, this is going to be an essential component that we'll need throughout the course in understanding the accounting equation and the components that fit into it. As you move through this section, you should understand the definition of what is included with the assets, liabilities, and equity, and also start to understand what accounts fit into those categories as well, as those will be essential as we work throughout the entire course. As it notes here, the accounting equation is our basic tool of accounting, where it helps to understand the resources of the business, which are our assets, and the claims to those resources, which are the liabilities or debts that we owe, or the equity or the components that we own of the business. You'll note here that the accounting equation must always be in balance. And so essentially, as we start to move into the next objective, we will look at all of the impacts on the accounting equation and see that it will always be in balance in adding and subtracting those to the accounting equation. Our first component of the accounting equation is our assets. And as it lists here, assets is an economic resource that is expected to benefit the business in the future. But an easy way to say that is that assets are things that we own, that we anticipate will again benefit us in going forward. We list some examples here of cash, merchandise inventory, furniture, and land, but I would also add other assets on this, like accounts receivable. Accounts receivable represent amounts of money that our customers owe us. They just haven't paid us yet. So for example, if we provide a service to a customer, but they haven't paid us yet, then we put it into our asset account of the accounts receivable. I would also add on to this accounts of assets like prepaid insurance, where we've prepaid maybe the next 6 months of our insurance, and therefore we will be using that over the next 6 months, but at this point it's an asset to us. Prepaid rent is another example of an asset where we've say prepaid for the entire year of rent, and we will be using that asset of the prepaid rent over that next year time period. We could also add on to this things like supplies or any type of equipment. These are also assets that we will be using in the future. Our next component of the accounting equation is our liabilities. As it notes here, these are debts or things that are owed to creditors. So liabilities are again any amounts that we owe to another entity. As it lists here, many liabilities do have the word payable in their title, such as accounts payable, notes payable, salaries payable. But I would also caution you in that there are other liabilities like unearned revenue that are also liabilities. Unearned revenue are things that our customer has prepaid to us, but we owe them a good or a service. So for example, our cell phone bill. If we pay Sprint for our next month of our cell phone bill, that is a liability to Sprint because they owe us the next month of the service. So that amount that we've prepaid to Sprint is again an unearned revenue to them because they owe us that next month of service. So again, while most liabilities do have the word payable in them, there are ones like the unearned revenue that also represents a liability. Our last component of the accounting equation is our equity. You'll note that equity, which in a corporation is also called stockholders' equity, represents the amounts that, again, the company owns of itself. So when we look at the equity, we can break it down into two different pieces. We can break it down into the contributed capital portion of it, and we can break it down into our retained earnings section. We look at components of our equity that both increase it and that also decrease it. The increases in equity relate to those that come from outside of the business, such as our contributed capital, so where our owners are contributing some amount related to their ownership interest. or it comes from revenues where we're providing services or goods to our customers. We also have decreases in equity that result from amounts that we're paying out to our shareholders through dividends, or amounts that we are incurring as our expenses. So therefore, when we are going through the course of our business and we are, in a sense, paying for amounts that we owe, and again, just through our daily operations, then again, we have those amounts of expenses that are coming through the business. When we look at our equity component, as I had mentioned before, we again have our two components of our contributed capital and our retained earnings. When we look at these amounts, they again are either coming from outside of the business, which is again that contributed capital. They also refer to this as the paid-in capital. So what is it, the amounts invested by the owners or the shareholders. And again, we represent this from that common stock account. And we'll see this as we start to work through our transactions. But you'll note that our equity section is our stockholders' claim against the assets and is the amount of assets that are left over after the company has paid off its liability. So we could think about this as the net worth of the corporation. If we again paid off all of our liabilities, this would again be the amount that would be left over. You'll note that we can break down our equity into, again, our two different components of our contributed capital versus our retained earnings. You'll see down below these then the different components that will run through our equity. We again have our retained earnings components where we see the dividends showing as reduction in equity, and same thing with our expenses. Both of those are reducing equity because they represent amounts that are being paid out of the business, either through the course of business through the expenses or through paying out our shareholders as a return through dividends. We have amounts that are increasing equity, such as the contribution of common stock, as well as the earning of revenue. Some important terms that we also see here, and we'll also find on our financial statements, which is our amounts of our net income or our net loss. We have a net income if our revenues or what we have earned in the business is greater than our amounts of our expenses. You'll again note that revenues are the earnings resulting from delivering goods or services to our customers, whereas expenses are the cost of selling those goods or services. So conversely, if we have a smaller amount of revenue than our expenses, then we have what's termed a net loss. And again, these accounts will run through our retained earnings. And we'll continue to talk about that as we work through the course. Our next objective starts looking at some transactions as they apply to the accounting equation. What's going to be essential for us as we work through this section, as well as in going forward, is that we need to start picking out the accounts that are applying to these various transactions. So the more practice that you can get in analyzing these transactions and picking out the accounts that apply to them, the better off that you will be. Our first component looks at what is a transaction first of all. A transaction, as it lists here, is any financial event that affects the business, and it can again be represented with faithful representation. This is another way to say it is it's a give-get transaction. We are essentially getting something and we're giving something out in exchange. So in our orange box here, buying a computer for the office for $2,000 of cash is a transaction where there's a give-get exchange. We are giving out cash and we're getting a computer in exchange for it. Whereas in hiring a new employee is not a transaction that needs to be recorded because we don't have a give-get exchange. Just the hiring of a new employee does not result in a financial transaction. Later on, when we start to pay that employee for the time that they've worked for us, then that would require a financial transaction. But again, up until that point, there's no give-get exchange. Our next transaction is the purchase of land for an office location, and we are paying cash. In looking at this transaction, you'll note it only affects the asset side of our accounting equation. One asset of land is going up, and our asset of cash is going down. So our accounting equation is still in balance, where it's again only affecting the left side of our accounting equation. But again, one asset going up and the other asset going down. Our third transaction is where we are purchasing office supplies on account. This office supplies on account piece of it is going to be important to understand who owes the money. In this example, Smart Touch Learning is the entity that owes the money, and therefore it becomes a liability. It's a liability because, again, Smart Touch Learning owes the money. In this example, they are buying an asset of office supplies for the $500. So we are increasing our office supplies asset. We are also increasing our accounts payable liability account because we owe that money. So therefore our liabilities have went up. Our fourth transaction is where we have earned service revenue for cash. When we look at the service revenue, you'll note it is a part of retained earnings, but we are using the account of service revenue. So the two accounts being affected here are our cash asset is going up and our service revenue account is going up. Service revenue increases our equity component, so that's why it's being added to our accounting equation. So our service revenue category has went up by the amount that we've earned, or the $5,500, and we've collected $5,500 of cash for it. Our fifth transaction relates to earning of service revenue, now on account. When we see that on account term and we think about who owes the money, it's our customer who owes the money. We as Smart Touch Learning have performed a service for our customers who do not pay immediately. So it's our customers or those clients who have to pay the $3,000 within 1 month. This account is then called accounts receivable because our customers owe us that money. So we are increasing the asset of accounts receivable because it's our customers who owe on account. You'll note we are also recording our service revenue increase because we have provided the service to our customer in this example. So therefore we can record the amount of revenue that we have earned. Our sixth transaction relates to paying expenses with cash. You'll note we have two expenses that we're paying in cash: office rent and employee salaries. So our cash is going down by the total of the $3,200. But you'll note in terms of our category of rent expense and our category of salary expense is being affected by the $2,000 and the $1,200. The category itself has increased in the amount of $2,000 and $1,200 for the salaries, but overall the effect on our equity, because expenses make the account of equity go down, we are showing those as a subtraction in our equity section. So although our amount of rent expense and our amount of salary expense have went up in the category totals, they are a reduction in our equity. So that's why we show them as a decrease in our accounting equation. Our seventh transaction is a payment on account. So when we think about that account or on account, we look at who is paying the money. In this example, Smart Touch Learning, or we as the company, are paying the $300 for the amounts that we had used to purchase the office supplies back in transaction number 3. So you'll note our category of our accounts payable is going down. We still owe $200, but you'll note in this example that we have reduced the amount of our liability. And again, for the accounting equation, we've also reduced the amount of cash that we have on hand. So you'll note in this example, it's again the accounts payable because we are the ones that are paying off our liability on account. Our eighth transaction relates to our collection on account. So meaning now our customers are paying us. So in our example, the customers have collected, or we've collected $2,000 from our customers from that transaction number 5. You'll note that it still affects only one side of the accounting equation, where we are increasing our cash by the $2,000 and we are decreasing the amount that our customer owes us through the accounts receivable. You'll note that they still owe us $1,000, but they've again paid a portion of their balance from that accounts receivable. Our ninth transaction relates to the payment of cash dividends, which just represents a distribution to our owners, or in this example to our owner of Sheena Bright. So you'll note on our accounting equation affecting both sides, our cash account or our cash asset is going down, and you'll note our category of our dividends is showing as a reduction in our equity, because again, dividends and expenses reduce our equity. In total, the amount of our dividends account has went up in terms of the account itself, but again, dividends reduce the equity, which is why it's shown as a negative amount. In summary, this shows the total of all of our 9 transactions here and our effect on the accounting equation. You'll note from the very bottom part of it that our accounting equation is still in balance. Our assets in total equals $30,500, and our liabilities plus our equity also equals the $30,500. When we look at every single transaction that we've went through here, every basic transaction always affects at least 2 accounts. So as you become familiar with each of these transactions, we see that always in this example at least 2 accounts were affected, and this will help you in as we go forward when we get to their debits and the credits and journalizing transactions. It will help to make sure that you understand that part of it. Every time you look at a transaction, you should always pick out which 2 accounts or more are involved. Think about what type of account is affected in each transaction. So is it an asset, a liability, or an equity component? And does the account increase or decrease? This again will help you to work through these transactions and analyzing them, especially from when we get to the accounting equation part of it. And again, keep in mind that some transactions only affected one side of the accounting equation, and again, that's okay. And in those effects, we saw both an increase and a decrease on that same side. But just again, make sure that we're understanding these different pieces as we work through our transactions, and that will help us when we get to the journalizing part of it. Our last objective talks about the preparation of our financial statements. When we look at the financial statement portion of it, this is that communication process that takes place for all financial statement users, both for the financial components or financial statement users, as well as the managers who use them as well. So financial statements are really important and key piece of the accounting process because it's that communication factor that helps us as all financial statement users understand what's going on within the business. Each financial statement provides something a little bit different for all financial statement users. You'll note that each of the financial statements is required by GAAP, and it focuses on a different aspect of the company's financial position or their financial activity. So all of these 4 statements should be analyzed in order to get a complete picture of what's going on within the company. The first financial statement that is prepared is the income statement. You'll note that the income statement looks at the profitability of the company. When we talk about profitability, we notice that it is a difference between our revenues and our expenses, which equals the net income or net loss that we had discussed in a different slide or several slides ago. The income statement again looks at the profit, and that doesn't necessarily mean money. The profits do not have to be collected in cash yet. We again look at what's happened during the year and again comparing the revenues versus those expenses. Our second statement that is prepared is our statement of retained earnings. And this just helps those financial statement users to understand what earnings were kept, so meaning the net income and the net loss, or depending upon, again, the comparison of the revenues and expenses versus what was paid out in dividends. So when we look at the connection of our income statement to our statement of retained earnings, the amount of the net income or net loss carries forward to that statement of retained earnings. So it again just shows the changes in equity that arrives from the operations, but again, not changes in our contributed capital, the amounts that were contributed for common stock. So then we subtract out those dividends. And as our profits increase, then our equity increases. And as dividends are paid, then again, those profits will go down, or what's retaining in the business will go down. So just looking at the connectivity, we'll see the net income carry forward to our statement of retained earnings, and then we'll see that ending retained earnings balance carry forward to our third financial statement, which is the balance sheet. You'll note that the balance sheet is the financial position of the company, and that is distinctly different from the profitability, which we talked about related to the income statement. So a company, in looking at the balance sheet, again provides a snapshot of how well the company is doing. So again, the liquidity of the business. So essentially the assets equaling the liabilities plus the stockholders' equity. So we could look at the company's assets, so what they own, and whether they owe a lot of debt on that, or whether that is truly owned by the company through their stockholders' equity. Now, looking at a company, it could be very profitable through the income statement, but do a terrible job of managing those profits, so through looking at then the balance sheet. So again, this is just important, especially as you get more knowledge base and working with these financial statements. It's important to understand what each of them is telling you. Some, again, may look at high income levels and, again, not have a lot of it maintained in the business through the balance sheet. But again, understanding what that means is, again, very important. In looking at our last statement, the statement of cash flows, it again reports the company's cash receipts and cash payments. We have three different sections of it: the operating, investing, and the financing activities. You'll again note that statement of cash flows essentially tells us where the cash is coming from and what we are using it for. It's important for many different financial statement users to understand what's going on with the statement of cash flows, because again, the net income and the cash flows are very different concepts. Net income is calculated based on the accrual basis of accounting, which we'll talk about in a later section, whereas the statement of cash flows is related to the cash flowing, again, where the cash came from and what we used it for. So neither of them is, again, tells us specifically what we need to know about a company. We have to know both of them. So again, a company could have a net loss in a particular year, but have a positive cash flow. And many creditors do focus on this cash flow piece of it in order to determine whether a company can generate some cash in order to pay back their outstanding liabilities, because it's, again, telling them something very different than what the income statement does. So all very important concepts to understand and what these statements can tell you and what they mean to those financial statement users. And I do want students to understand those different components. We will focus a lot on the income statement, statement of retained earnings, in our balance sheet. And so you do really need to know the ins and outs of those. And for the statement of cash flows, I just really want you to understand that it's reporting where the cash is coming from and what we're using it for. And again, we won't cover in this course the preparation of the statement of cash flows. That'll be for a future course. So in looking at our financial statements, these again are the key documents used to communicate what is going on in the business. And as is mentioned in the last slide, that they tell us something different about what is going on in the business. We do have the interconnectivity of our financial statements, where again the amount of our net income or net loss from our income statement carries forward to our statement of retained earnings. And that again helps us to calculate the ending balance of our retained earnings, which then carries forward to our balance sheet. So we have our ending balance of our retained earnings from the statement of retained earnings disclosed on the balance sheet. You'll note that these three statements are again prepared in this particular order, and we have to have these three statements complete before we can prepare the statement of cash flows. So this is again part of the interconnectivity of what's going on within the company itself. The first financial statement we always prepare is the income statement, which reports the net income or net loss for a period of time. So in this particular example, it's for the month ended November 30th. We look at all of the transactions that have happened for that particular time period, and it's summarized in terms of profitability with the revenues and the expenses. You'll note the revenue accounts are always listed first. In our particular example here, we just have service revenue, but as we progress throughout the course, we'll be adding additional types of revenues in this category. The next component is the expenses. You'll note that expenses are listed separately, typically from the largest amount to the smallest, but those help us to understand what amounts were paid out for the particular time period in generating the revenues. The last dollar amount is the amount of net income. If we have the revenues greater than our expenses, it shows net income, i.e. the profit is a positive amount, and that's what we want to see from a company perspective. However, if the expenses were greater than our revenues, then we would see a net loss, or where essentially the company lost money from a profitability standpoint. So that helps us to understand a reason why certain financial statement users would look at the income statement, because it helps them to understand more about the profitability of the business over that given time period. The second financial statement that we prepare is the statement of retained earnings. You'll note that we have a similar heading here with the company name, but we have a different statement name. Instead of income statement, this is now the statement of retained earnings, but it's also for that same period ending, or for that same time period that we saw in the income statement. It's for the month ended November 30th. You'll note for the statement of retained earnings, it helps us to understand what happened in that equity account over that given time period. This is also the first place where we see the interconnectivity of those financial statements, because we are taking the amount of net income or net loss from the income statement and it carries forward to our statement of retained earnings. So because we are just starting out our company of Smart Touch Learning, we have a beginning balance as of November 1st in our retained earnings account of $0, but we are adding to that the dollar amount of net income, again from the income statement, and we are subtracting the amount of dividends that were paid out. So that gets us to the ending balance of our retained earnings for the November 30th date. You'll note that this balance for retained earnings will be carried forward to our next financial statement or the balance sheet. So just to think about some reasons why financial statement users would look at the statement of retained earnings, it helps them to understand how the equity or ownership interest of the business have changed. So keep in mind the retained earnings are all of the income of the company that have been maintained in the business but not paid out in dividends. And that's exactly what we see here in the calculations. Our third financial statement that we're preparing is the balance sheet. You'll note this is the one financial statement that it is prepared as of a particular date, not a time period like we'll see on all of the other financial statements. The balance sheet is the financial statement that is a summary of the accounting equation, where we have the total of all of our assets, liabilities, and our equity accounts. You'll note the interconnectivity of the statements again, where we see the ending balance of the retained earnings accounts, which came from the statement of retained earnings. It's not that beginning balance of $0 that we saw, it's the ending balance of $300 that carries forward to the balance sheet. And looking at the balance sheet, we'll kind of be changing it as we move forward throughout some future chapters in the course. But for right now, we're just listing all of the assets together. And then we'll see on our other side the liabilities and our stockholders' equity. We'll see in terms of formatting that based on the accounting equation, the total assets should again equal the liabilities plus our stockholders' equity.
by looking at the balance sheet helps us to understand, or what we'll look at later, the liquidity of the business, because we'll see the breakdown between, again, how much is in assets versus liability and what's current versus long term, and also the solvency of the business, which again helps us to understand we have assets that the company owns, and do they own them because they have it in stockholders' equity, or do they owe on it through the liability section? So it again kind of helps us to understand risk associated with maybe investing in that particular company, or for another lending institution, what that might look like if we were to loan them out some money. Our final financial statement is our statement of cash flows. Again, you'll note that this is for the month ended, in this example, November 30th. We have in our statement of cash flows an understanding of where the company's cash came from and what they are using it for. You'll note that there are three major sections in our statement of cash flows through the operating activities, the investing activities, and our financing activities. And you'll note again where that cash came from and what we're using it for in terms of positive and negative numbers. In this particular course, in this chapter, we don't need to worry about the calculations yet for how we're getting those numbers, but I just want students to understand that the statement of cash flows we again look at to understand where the cash came from and what we're using it for, because it helps us to understand the change in the cash balance for that particular time period. And we'll learn later on more about the breakdown of how we understand our different activities and what goes into those activities.
So that brings us to our last objective. When we look at our last objectives, this is our return on our assets. So a lot of times we can use our financial statements to help us understand a little bit more about what's going on in the company. When we get to all of these different ratio calculations, again, don't expect students to understand the formulas of them or the calculations of the numbers, but I do want students just to understand the overall perspective and what the numbers can tell us. So our return on assets, as it lists here, measures how profitably a company uses its assets. When we look at that, that's a really important concept because it is based off of the amount of assets the company has versus the amount of their net income. So it helps us to understand whether they're using those assets to generate income. So the more that they're using those assets, the higher this return on assets should be. When we think about this calculation, it is again based off of historical cost. So meaning what we again paid for those assets. But again, when we look at those valuation, it's still important to again understand that the higher the return on asset, the more effective the company is at using those assets in order to generate the net income. Now, we couldn't have gotten this information by just looking at our transactions. We have to, again, pull those from the financial statements. And that's the really important piece of accounting. When we look at analyzing not only the transactions, but in putting those financial statements together, because that's the key piece that helps us to understand of whether we're making good decisions, especially from a manager perspective. So this brings us to the end of our discussion of accounting and the business environment. Through this entire area, we again looked at why accounting is important, as well as the users of the accounting information. So both from the financial accounting aspect, as well as from the managerial aspect. We also looked at various organization and rules that govern accounting, such as the SEC, the FASB, the IASB. We also looked at so those different rules. So again, the GAAP, as well as some international financial reporting standards, and then breaking them down between our going concern assumption, monetary unit assumption, economic entity, and our cost principle as well. Those concepts are again very important to understand, forming the foundation of GAAP. We also then looked at the accounting equation, helping to understand how it works as we apply them to various transactions, and then looking at the components of defining assets, liabilities, and equity. And those again are really key pieces for us to all understand, especially as we work throughout the course. We then looked at preparing our financial statements. So first off, the income statement, then our statement of retained earnings, our balance sheet, and again, focusing on those first three. And again, we would also prepare the statement of cash flows after that, although we will not focus on it, especially as we work through this course. The last one, looking at using the financial statements and how we can calculate a return on assets and what it is used for. These again are all important concepts to look at and make sure we understand as we work throughout the course. There's also some other files I would definitely encourage you to look at that'll help applying these concepts and also making sure you're going through the practice problems and exercises in applying these various concepts as well. As always, if you have questions, please don't hesitate to ask. Otherwise, I hope you have a wonderful rest of your day.